Kris Krohn here. Today, I've got Dolph DeRoos in studio, and we're having a lively debate about 2023. Is this going to be a market that gets worse? Do we have a recession on the horizon? Is the market going to bounce back? Are prices going to go up? And you're talking to guys that have been playing in real estate to the tune of billions of dollars. And Dolph, thank you for being here today.
My pleasure. Thanks for having me.
One shot, now the future is yours. Go! I'm turning dreams into reality. Yeah, it's one shot, now the future is yours. Go!
All right, so check it out, brother. 2023, what do you think is going to go down? That's what I really want to talk about today, because 2022 for most people has been a really crappy year, right? We had a pandemic, we got a war, we've got supply chain issues. Economically, it seems like everything just keeps getting worse.
That's true. And the public's going to think that 2023 is going to be worse, which means for you and I, it's going to be better because there'll be opportunities.
No doubt. I mean, this is going to be an amazing time to be investing, but I'm concerned for all the people out there that because they refuse to get financially educated, hopefully if you're watching this and getting yourself financially educated, this is going to put you in a position where you can take advantage of all the opportunity out there. Someone's got to clean up this mess. The government's not going to do it. Usually comes down to the investors out there that say, hey, there's opportunity, let's clean this thing up. Were you on the global financial crisis cleanup crew of 2008?
Well, of course, most people were, or most people that I know were, because the opportunities in were enormous. And we've just got to make use of them. We've got to make hay while the sun shines.
So I'm putting up this inverted yield curve. The Treasury yield curve has accurately predicted the last 10 recessions. Because here's the question, are we actually in a recession? Typically, the returns on short-term notes are lower than 10-year bonds. However, when investors are uncertain of the market, they flock to the 10-year bond for security, causing an inversion in the yield. The yield curve is currently at its biggest inversion since the 80s, with a spread of 0.59% as of November 4th. This is just data saying, I think we're in a really bad one. The question is it, first, are we in a recession? Number two, is it going to be worse or not as bad as 2008?
Firstly, the numbers are absolutely accurate. We are headed towards what could be called a recession. It's not going to be nearly as bad as 2008 for a number of fundamental reasons. Back then, there was a surplus of real estate in the market. Now there's a chronic shortage of some 3.9 million housing units, and new housing starts have slowed down because of this supposed recession. So in that sense, yes, we're headed into something bad, but it's not going to be nearly as bad as 2008.
Well, let's talk about the fact that there's a difference between a recession and also a real estate recession. Because when the stock market goes down like it has been, it's really bad right now. Does that mean that real estate is really bad? Do they have to coincide? Thoughts?
Well, there's that old saying that the difference between a recession and a depression is when someone you know loses his job, and a depression is when you lose your job. So it's all relative, right? It's all depending on what's going to happen. Yes, we are headed towards a slight downturn. The number of days on market is going to increase. The prices achieved by properties is going to go down. The number of offers put in is going to go down. But that gives opportunities for those in the market who want to buy. People are still going to live in homes.
Yeah, statistically, in any type of market downturn, real estate only correlates with that downturn 2 out of 5 times.
Correct.
And so right now it's kind of interesting because real estate is going down, I think, for one major market force reason, and that is what the government is doing with trying to control inflation by increasing rates. Because they said each quarter this year that they were going to increase rates, and on average, they have added 0.75%. They've almost doubled rates from 3%. They're sitting closer to 7%. Just last week, they increased rates again. Do you think they're going to keep doing that?
I think they are for a while. They want to use the only tool they've got at their disposal to rein in inflation. So they do what they do. But when we look at history of America, you will not find a 10-year period of time where prices were lower at the end of the 10 years than at the beginning. So my view is whatever they do, it's going to go up and down. Things don't go up linearly over time and monotonically, as the mathematicians say. It goes in fits and starts. Don't be too concerned about it. If you see an opportunity to buy something, buy it, because in 5 years' time, you're going to say, man, if only I'd bought 2 of them.
I get it. Will sales decline? Even with the current market slowing down, Nadia, senior economist for NAR, has predicted a further drop of home sales by 7 to 15% next year. Listings are also predicted to stay on the market for longer, like you were talking about, an average of 30 days instead of 3 days with 50 all-cash offers like we had for almost 2 years there. In this market cool down, do you think we are going to see a 7, 10, and 15% drop like she's predicting, like Moody's predicting?
Yes, I believe so. The drop-off payoff in real estate values may even be bigger. But here's the interesting thing, Kris, and the crucial thing when you're an investor. When you're an investor, you're not looking at being an owner-occupant and living in it. You want to get rental income. I don't think rentals are going to come down nearly as much as the value of real estate itself.
Yeah, it's interesting. So back in 2008, I went into markets like Phoenix, Vegas, Florida, and bought thousands of homes. And it ended up being the best time. But all the headlines said it's the worst of times for real estate because guess what had happened? The prices had dropped. So when I went into Phoenix, I was buying $350,000 to $400,000, homes that were selling in 2007, 2008, 2009. I was now picking them up for $80,000 to $130,000.
Exactly.
And the question is, how long can you actually go without stimulating the market with building new homes before population catches up? Because like you said, people don't just disappear. They don't become homeless. They're going to be renters. And eventually those renters are going to become buyers again. It took 5 years for the market to swing back and already do enough recovery that I had made my investors over $100 million. So are we going to see downturns like 2008?
No, not nearly as big, not nearly as much. We're going to see a downturn, but I think the recovery is going to be a lot quicker too.
Yeah, and there's definitely a lot of opportunity. I think, honestly, 6 to 12 months from now, the number of REOs, real estate-owned listings that are going back to the banks, people that are struggling on their payments. Like right now, I think I just saw a stat that said 4% of all people are struggling to make their payments. Well, if that number continues being on the rise, because people bought when rates were higher, they were chasing the market went up, and they closed at a higher interest rate, that's going to start hurting people's wallets. And there's a prediction, I think, in the next 6 to 12 months for a lot of these homes starting to go back to the banks. That means there's going to be a lot of discounted real estate hitting the market. Not as desperate as 2008, but certainly really, really strategic buys.
Absolutely right. And it depends too what happens to mortgage interest rates. Remember that here in the States, we fix our rates for a 30-year term. So everyone who bought up to a year ago got really low interest rates.
Yeah.
They don't want to sell. They won't want to upgrade their homes for a while because they'd be swapping their existing home at 3% interest for one that might cost them 5 or 6 or 7%. So the demand for homes is going to go down from the improvement brigade, from the people who want to, upgrade their living circumstances. However, all the people who would have bought a home with interest rates being low, and they haven't been low, they've gone up, they're still in the market. They're still looking. So I think the market's going to level itself out pretty quickly.
So 2023, is it going to be a buyer's or a seller's market? Rate hikes along with a shortage of availability have pushed many purchasers to the sidelines. Most experts predict lower home prices in 2023 due to the decreased demand from buyers being priced out of the market. However, this will happen gradually, and next year will largely remain a seller's market. Agree or disagree?
I agree with everything except that last clause. I think it could be a bit of a buyer's market. I think people are going to panic. People always overreact. They think it's a massive recession coming along when it's not. It's a minor downturn. But because of the psychology, they're going to get rid of their properties at prices that they'll regret in 2 or 3 years' time.
It's interesting. If the government actually comes back next year, if they can control inflation and start bringing rates down, I think we're going to see that buyer's market come back really hard and strong. And I think that we're going to start, we're still missing millions of homes. In fact, since 2008, a month did not go by leading up to this recession where we didn't get behind an additional 100,000 homes that needed to be built that weren't. And so we still haven't caught up since the global financial crisis.
Right. It's nearly 4 million that we're short right now.
Yep. And so even though we're not seeing demand for that because of really, really high interest rates, the moment those drop, I think the market is going to go back, and I think we're going to see prices shoot back up. So I know what I'm doing. I'm kind of curious, Dolph, what are you doing?
I'm sitting on the sidelines right now waiting for a bigger price drop, and then I'll be in the market, boots and all.
I'm buying a lot of homes right now below the median in kind of that safety range. I typically buy 20 or 30% below where the median, as I track it, should be. For 2 years, we had the market go up with these unprecedented gains, basically 40, 50% increases nationwide on real estate. But over the last 65 years, the average increase is 4.65% nationwide. So I've been tracking that and tracking what the market should be. And even though we saw, the national median go from, in 2 years, 260, 270,000 to like just over 400,000, by my guesstimation, it's still supposed to be under 300,000. So I've been buying 35% below that. Most of my homes are buying, $200,000, $220,000 price range, where the cash flow is there, the growth is there. But I'm buying up as much as I can right now, knowing that where the correction lies in the higher range, I'm going to be snatching those up when those come down as well.
Right. No, we're in for a good time, I think, despite all this talk of recession.
So here's the question. What will happen to home values? This comes from Fortune. This is their prediction. They say home values on a national level are almost certain to decline at least modestly, perhaps between 5 and 10%. However, limited inventory, demand from young adults, and strong credit quality amongst current mortgage holders should help prevent prices from falling even further. Agree or disagree?
I totally agree with that, yes.
It can't be that big of a drop-off, right?
No, it
I mean,
won't
you have
be.
some markets that got crazy. I mean, if you actually look at some parts of Utah, Idaho, Arizona, we saw some things on the East and West Coast where it was exorbitant what they climbed to. I think that we're going to see some bigger corrections in some of those markets. But nationwide, 5, 10%. And then as soon as rates lower, I think they're just going to shoot back up again.
I fully agree. We take too much notice of what's happening in the micro world. We should look at the macro. We should look at the long term. Over a 10-year period, will we have done well buying in 2022, 2023? And the answer will be absolutely yes. 2023
really worries me, though, when it comes to long-term sustainability with affordability. Like, what can people really afford? This comes from Redfin. The median sales price of a home in the U.S. was $403,000 in September. This is an increase of 7.5% from the price of $373,000 in September of 2021. Assuming a down payment of 10%, the monthly mortgage payment is now $1,000 more expensive than it was a year ago. With the shortage of homes and the slowing of home building, home affordability will likely remain difficult in 2023. Do you really see affordability improving much then if prices are going to keep bouncing and going back up?
Not in the short term, but in the long term, yes, they have to. Otherwise, people will stop buying homes. People will stop immigrating here. Everything balances out in the long run.
So let me see then if this is what you believe. If we take that 4 million missing home VAT and we solve for 3 or 4 million of that and bring it back, it could take 5, 6, 7, 8 years to do that.
Correct.
Are you thinking that at that time is when we'd see a major correction?
No, I think at that stage, interest rates will have come down again, mortgages will be cheaper, and they'll be back to where they were, the affordability back in 2022, in the beginning of this year.
Interesting. Final thoughts, Dolph, on 2023. If you had to state as concisely as possible your predictions, what would you say?
I would say when we look from the perspective of the end of 2023, should you have bought something during the year? I don't know the answer to that, but I don't look that short term. I'm looking at 2030, 2035. Should we have bought in 2023? And the answer is an unequivocal yes.
Dude, it's kind of crazy when I look back to the financial crisis, and in 2008, everyone said you're crazy for buying real estate. And I didn't buy 2 homes or 10 homes. I bought thousands. And people thought we were just absolutely nuts.
Yeah.
And then 18 months later, Blackstone gets involved and starts competing against us. And then the other hedge funds get in. They start realizing, wait a second, this is like the greatest sell-off of real estate of the century.
Right.
And we had been doing it. And right now, look at this recession. And for me, I'm buying up as much as I can.
Right.
I think now is 100% the time to get in on the game. But if you're smart, right, I agree with you. If you're buying homes above the median, you need to wait for the market to
That's
correct
risky.
because you're going to get spanked.
Right.
We've got developer friends that are playing in the $1 million plus range right now, and they're having it handed to them hardcore right now. It's not pretty for them. But you get under the median, and for me, it's always a great time to buy.
I fully agree with you. And people, when they get old and retire, they tend to regret one thing. They don't regret the things they did that they shouldn't have done. They regret the things they didn't do that they could have done. And one of them is buy more real estate.
Well, and let's talk about why. The average person in their 60s has, right now today, the number has risen, it's gone up. But if you take a look at the average 401k and IRA combined balance, you're talking about a retirement of maybe $200,000, right? A very small amount of money. Yet you take a look at the average equity in their home, and it's greater than that. So just owning a home for 30 plus years did more, quote unquote, for their net worth
Than a lifetime of investing.
than a lifetime of saving for retirement.
And you'll hear couples say to each other, oh my gosh, honey, remember when the neighbor's house was on the market for 6 months and the grass was long? And we said, we wish someone would buy that house. It's
it
dragging down
should
the
have
whole...
been them.
And they should have bought it.
I know. Well, and I just think that it's like, wow, let's just say for a moment you retire with your house, let's just say paid off. You had it for 30 years. Let's say you never refinanced it. Let's say your house is now worth $400,000. What would happen if you had bought 5?
Exactly.
Well, you'd have $2 million, $400,000. The tenant pays it off over a 30-year mortgage, and now you have 5 paid off homes. It's not the best retirement, but you are literally 10 times better off than the average
Exactly.
American that just didn't buy real estate.
And the fact that your own home, you've paid it off, is worth $400,000, twice the value of your retirement. You don't benefit from that really because you can't sell it and live off that because you have to pay rent somewhere. It's only if you buy a second house or a third or a fourth.
Yeah, you're right. I mean, you've got that equity play, that home equity. There's a lot of people that are still living fat off of huge equity gains from the last couple of years.
Right.
And there's a lot of people watching this that are thinking, okay, Kris, what would you do if you were me? Well, Dolph, I'll tell you what I would do. And I'm curious if you agree or not. I keep a document on hand. I send it out to people in the mail. It basically catalogs my last several thousand deals that I've done. It shows my track record. Pre-2008, post-2008. We're now sitting in the same cycle, but just not as dramatic. I just tell people, if you've got equity sitting at home, let alone 401ks and IRAs, put that in the game of real estate because real estate gives you the power of leverage, right? So if your 30-year average on a 401k or IRA combined is around 5-6%, but we know that just on appreciation alone, nationwide, that real estate appreciates at 4.65%. The difference is in investment grade real estate, the bank will lend you 80% of the money, which means that your 4.65% on your money, you can basically multiply that by 5, and you're picking up a 20% ROI on the bank's money. It's like, how can 401k or IRA even compare with that?
And there's no other industry that you can get involved in, that you can invest in, where banks are vying with each other to give you that money to buy the
They're
product.
eager.
They don't say, hey, want to buy stocks, want to buy bonds, want to buy unit trusts or whatever. Come and see us, we'll give you the money. But they do for real estate. So I have this saying, banks want to give you money, let them give it to you.
Yeah, it's interesting because in real estate, you got multiple profit centers. And I got people that partner with me from all over the world. Once I really explain to them, what if you're making 20%, 15 to 20% a year on your money just from appreciation based on that 1-to-5 lending ratio? What if you're making 5% on your money just from a tenant paying off the mortgage? Because that's what it is on average. What if you're picking up another 5% in cash flow? What if you pick up another 5% in depreciation? I mean, there's a reason why I average 34% a year on my money before we even talk about tax benefits on the last 10 years of buying and holding as a short term this kind of real estate. And so if anyone's watching this video, there's a link below. If you want to partner with me and learn what that looks like, let me send you this document. Let me send you the strategy. Let me literally steal it from you, use it yourself. Like, do something to improve your finances. But just know that I got a team of 200 experts, and we go into the market and we basically line this up as partners, and we do all of this for you. So it's very passive. It's very hands-off. It allows you to really focus on what you're supposed to be doing through your life, but make sure that you have a way to retire a multimillionaire. Dolph, based on your track record with me and history with me, good idea or bad idea?
Brilliant idea. Absolutely do it.
Guys, Dolph, thank you for being here with me today. Everyone
My
else,
pleasure.
thank you for joining on this video. And listen, get in the game. Make something happen for yourself. Get a copy of this. It's free. You got to cover the shipping on it. But let me get you all the information. And then after that, if you want to take a look at getting your money earning something superior in a recession, I believe that recessions are where fortunes are made. And most people don't get that. They don't understand that. And so that's my recommendation. Other than that, if you enjoyed this video, the internet really thinks you're going to like this video next. So click this one and I'll see you right there.